first we'll discuss about inventory. So usually in a problem, okay, you will be like given a trial balance and there will be an internal inventory value, something like opening stock value, closing stock value. But how do in real life companies determine like what is the value of inventory? Because in exams you will be like given the value, but in real life the value has to be found. Okay, so how companies find out the inventory value? So any inventory, okay, is like comprising of all these elements put together. For example, any goods purchased for resale is an inventory. Consumable stores such as oil, okay, is an inventory. Raw materials and components used in the production process, it's a inventory. Partly finished goods, usually called work in progress, is also a inventory. And finished goods which have been like created by manufactured companies are a inventory. Okay, so all these things represent the inventory. So the number that you see in an exam problem, okay, as an inventory is just a single number, but in real life it is not just a single number. If you go and search for annual report of company, you will see that the annual report will show inventory as a single number, but it will also tell you something called as a working note. And if you go to that working note, you will see like, so how do we value the inventory? So the cost that has to be included in inventory is like given by the standard. So cost includes all the expenditure incurred in bringing the product or service to its present cost and condition. So that is like the cost that you have to take. So in detail, these are the costs. The cost of purchase, the material cost, the import duties and the freight. So any taxes that you have paid on that purchase of that item, you have to take it into the cost of purchase. Cost of conversion, this includes direct cost and production overheads depreciation of productive machinery and buildings. So for example, if you are going to create a finished product, okay, by using raw materials, then the direct labor cost, direct material cost, okay, and the production cost and depreciation of productive machinery in building, all these things you have to take into account and you have to find out the value of the inventory. Absorption costing is used, hence production overheads are included. So you have to take also the any overhead which is included. Okay, so some of the terms might be so very new to you, so don't worry about that. When we do a problem, you will get a better idea. But you should not take into account certain expenses at all. Okay, you should not take selling cost, storage cost, abnormal waste or material, labor and other cost. You should not take administrative overhead. So up to production expense you can take. Okay, after the production of items you should not take any other cost. Even storage cost you should not consider as a part of inventory. So let's see this quiz. Which of the following cost may be included when arriving at the cost of finished goods inventory for inclusion in the financial statements of a manufacturing company? So which of the following could be included? Carriage inwards we can include because we have to get the raw material from the supplier to our company, so that is included. Carriage outward is carrying the goods outside of a company to our customer place, so that we should not include. Depreciation of factory plant, that we can include because it helps in the production of the final product. Finished goods storage cost, no. Only up to production cost we could take. After production, the storing and all we should not take. Factory supervisor's wage, that we can take because it is because of his supervision the good gets produced. So 1, 3, 5 are the answer. So C should be the answer. So the answer is C. So now we will look at like further rules regarding valuing inventory. So the rule says that if you are like first time you are like purchasing the inventory, okay, the rules that we earlier saw are what has to be followed. Once you have recorded it, okay, once you have recorded at the cost, thereafter like subsequent valuation, okay, subsequent valuation we have to do it based upon the this rule. Net realizable value or fair value loss further costs to sell. Okay. So what is NRV? So NRV is the sale value or fair value, okay, minus further cost to sell or further work in progress. So you can either value the inventory or cost, okay, or net realizable value, whichever is lower. When items of inventory are obsolete or old or obsolete, they are likely to be valued at NRV rather than cost in accordance with requirement. So what are we like dealing here? See, usually inventory are kept only for 1 year and then it is like sold. Okay. But sometimes what happens is we could have bought some what to say, some finished goods from some other company, okay, at 1,000 rupees, and we could have had it in this particular year. And in this particular year, okay, that seems to be like we have bought it, and it would, and that is what we are going to value, have it as the closing value. But during the year, what happens is the good is damaged, okay, and if you sell this good now, you will get around some 500 rupees, okay, you will get only like 500. So now should it be valued at 1,000 rupees or 500? The answer is whichever is lower. So as you have bought at 1,000, that is what the value you should have shown in closing stock. But now there's a damage, okay, now the rule of NRV kicks in, okay. NRV says that either it should be the cost or the NRV, whichever is lower. So now you have to show the good at 500 only. Okay. So that's a concept of valuing inventories here. So methods of calculating cost of inventory. So that is like one rule. We have another rule of uh, to find out value inventory. So assume that you are like a trader, okay? Either you are like a trader or you are like constantly buying the same raw material again and again, okay? It's like either way. So when you keep on buying the raw material again and again, okay, you could have bought it at different prices, okay? You could have bought it at different prices. So at what price it should be stored as inventory? So that is the concept here. For example, if you have bought like you bought something like 10 uh, components, okay, so the first 5 components are 10 rupees and the second batch of 5 components are 20 rupees, okay. So and you have consumed 5 components, okay. Now as you have consumed, that become a part of the finished goods and they might have been sold. There are still unfinished, unsold or unused components of 5, okay. So should you value at 10 or 20? Okay, you can value it in several methods. One is FIFO method, okay. FIFO method says the first which came in, that is like used, okay. The second which came, okay, that is forms a part of your inventory. So the second batch of 5 units came at a price of 20, okay. So you can have it at 5 units 100 rupees. That is your value of inventory. The next one is average cost method. So when you had the first 5 and the second 5, the first 5 was worth 10 rupees each, the second 5 worth 20 rupees each. Put together, the total cost is how much? 50 plus 100, okay. So it's 150. So all units should be priced only at 15 rupees per unit, okay, 15 rupees per component. So if you are having like only 5 units as a closing stock, they should be valued at the average cost of 15 per unit. So as per this method, your inventory value would be 75. As the earlier method it's 100, now this method is 75. So you also have periodic inventory and continuous inventory, okay. So these are like two systems which are used by different companies, okay, different kind of companies. So we'll see them and then we'll decide like what they are. So FIFO refers to the first in first out, commonly known as FIFO, is an asset management and valuation method in which assets produced or acquired first are sold, used or disposed of first, okay. The first bought inventory is first used. FIFO assumes that assets with the oldest cost are included in the income or cost of goods sold. So the asset, the component that is like first bought is like first consumed, okay. The second batch would be like consumed later. The remaining inventory assets are matched to the assets that are more recently purchased or produced, okay. So the remaining asset, the second batch of inventory would be like used to produce the latest product, okay. But the concept here is, see, it's not that in reality physically it can be like any unit we could have taken. Okay, we could have taken the second batch first and we could have used it. It is not about the usage here, it's about the valuation here. Okay, so don't get confused that the first component only will be used for the production. Even the second could have been taken. Okay, but still as per valuation we only take it as the first bought unit is first used. Okay, so the practical thing and the accounting thing would differ. So the next one is average cost method. So average cost method calculates the cost of ending inventory and the cost of goods sold for a period on the basis of weighted average cost per unit of inventory. Okay. So here anything which is like bought, okay, immediately we find out an average, and this average is the price at which we have to value the inventory. So we have a problem for this. We'll do that. So how do we find out the value? We have to find out the total cost of inventory. Every time we purchase something, we have to find out the total cost of inventory, and then we have to divide by the total units of inventory. Okay, so assume that the first 5 units are 100 rupees and we bought 5 units, so it is 100 by 5. So it is comes to sorry the first bought units are 50 rupees and 5 units we bought, so it is 10 rupees. The second bought units are 100. So 100 plus 50 is 150 divided by 10 units. 5 plus 5, 10 units. So it becomes to 15 per unit. Okay. So every time we purchase, the price will be refreshed. AVCO is applied differently in periodic inventory system and perpetual inventory system. So this is what average method is. So whenever we purchase, we recalculate the stock value. Okay. So there are like two methods under this. So one is the periodic inventory system. So what is periodic inventory system is, see here, the value of inventory is calculated on a periodic basis, such as weekly, monthly, quarterly kind of basis. Okay. So what we do here is, uh, for example, if you take a manufacturing company, they have like so many different types of components. Okay, if you take a bike manufacturing company, they have brakes, they have accelerators, they have like indicators, speedometer, they have like so many components. Okay, they can't like find out the value of each component on a daily basis. So monthly once they try to find out like what is the total inventory value. Okay, so that is called as periodically they try to find out the inventory value. It is then multiplied with the number of units sold and number of units in ending inventory to arrive at cost of goods sold and value of ending inventory respectively. Okay, so we'll do a sum for this. It's like difficult to understand the theory part. So where it is like used, see, this method is used in cases of where the value of the component is low. Okay, and the volume of the component is so high, so counting it on a daily basis is like impossible. Okay, and distinctive inventory such as raw material components. Okay, so mostly it is like used in automobile companies where there are like several inventory and components are there, and they are all of low value only, but the number of volume, okay, the number of units are so high, so we can't like keep on counting them on a daily basis. So we use periodic inventory system. So the next one is continuous weighted average cost. With this inventory valuation, an updated average cost per unit is calculated following a purchase of a good. Okay, so this is like a pure version of the average cost method. Every time we purchase a good, okay, immediately the inventory valuation is updated. Okay, so the cost of any subsequent scale sales are then accounted for at that weighted average cost per unit. Okay, so anytime we purchase, the existing prices are like updated, and the latest of that price, okay, the average price is what at which the subsequent sales are made. Okay, in continuous inventory system, merchandise inventory and the cost of goods sold are updated continuously on each sale and purchase transaction. Okay, so it's like constantly they are revising it. Okay, so this procedure is repeated whenever a further purchase of good is made during that accounting period. So any time a purchase is made, the price is refreshed. So where it is used, see, this kind of an thing is used in high value and distinctive inventory items. Okay, so for example in jewelry, so a company which has a lot of diamonds, okay, So they might periodically, it's not like periodically, every time they buy diamonds, okay, each diamond has a different value. So to find out the closing stock value, they update the value of the goods which have been received, okay, and goods which have been sent, okay. So at every day they will know totally how much diamonds have come in, what is their worth, okay, and it will be updated to the inventory system and it would be consumed or sold, okay. So this method is usually used only to find out the inventory value, okay. We are not like trying to find out like uh, what to say, uh, we are trying to find out the value of inventory, the cost of goods sold and the sale value, like that only we are trying to find out. We are not trying to find out like exactly which diamond has been like consumed, okay. It's not that kind of a logical system is not there. Every time we buy a diamond, the price of the total inventory gets revalued, okay, and every time a particular diamond goes out, okay, it goes out, that actually the price, the average price gets added to the jewelry here, okay. But this is only for inventory sake. It's only for inventory sake they do it, provided all the diamonds are like very a little bit similar to each other, okay. It's not like very hugely differently diamonds are there, okay. So that's about continuous weighted average cost. So we have a quiz. Which one of the following statements about the use of a continuous inventory system is incorrect? Which one of it is incorrect? In a retail organization, a continuous inventory system can be used to keep track of quantity of each stock item available in its distribution center. Yes, they have to keep on finding out their value of inventory. Under continuous inventory, the cost of each receipt of inventory and the cost of each issue from the inventory is recorded individually. Yes. So uh, every item is like individually they have a particular value, okay. Every diamond has a particular value. For average inventory sake, it's like average out, but every individual diamond, okay, has a particular value. A continuous inventory system removes the need for periodical physical inventory count. So we don't need to like every day count it, okay, because every day it is like automatically discounted, so we don't need to separately count it. Both the FIFO and AVCO methods of pricing inventory may be used within a continuous inventory system. I don't think this is like possible. Okay, so I think D. Okay, C seems to be the answer. A continuous inventory system removes the need for periodic physical inventory count. Okay, so counts has to be made. Okay, counts has to be made. So that's about this quiz question.